Hi, welcome back to this, my fifth data update for 2024. In my last two updates, I've looked at the macro and micro components that go into hurdle rates. Equity risk premiums, default spreads, and risk-free rates as the macro, and company-specific risk measures as the micro, betas, ratings. Those hurdle rates become our required rates of return, and I said companies need to beat those to consistently deliver value. In this post, I want to look at what companies invest back in capital and whether they earn a return that is sufficient on that capital to cover their hurdle rates. In particular, I want to look at profitability. Now, before I do that, though, I will spend some time talking about the end game for businesses. What is it that you're trying to do? What is your objective as a business? That discussion might not have been necessary 20 years ago, but we live in different times, and that is where this discussion has to start. So let's start with the end game in business. As some of you know, I teach a corporate finance class, and my corporate finance class is about the first principles that govern how you run a business. It's the investment principle, the financing principle, the dividend principle. The investment principle looking at where you invest your money, how to make investment judgments. The financing principle determining how much of a mix of debt and equity you use and what kind of debt. And the dividend decision determining how much you return to your shareholders. In doing all of this, the central objective for a firm is to maximize the value of the firm. This is traditional corporate finance, conventional corporate finance. If you want, you can call it the Milton Friedman view of corporate finance. In fact, in the last 2 decades, when people have taken issue with private businesses and capitalism, they've not taken issue with the maximizing value. They view businesses as being profit maximizers. Actually, the truth is more subtle. Increasing profits is good if it increases value. And for some companies, especially mature ones, the two might converge. Increasing profits and increasing value might go together. But for many companies, there will be a divergence. For some companies, especially younger companies, you might give up on making profits now. In other words, you're willing to make losses to increase your value, to scale up your business. In fact, my biggest critique of private business is not that they're too profit-oriented, but they're not profit-oriented enough, especially younger companies. They value scaling up so much that they've lost sight of the criticality of making money on that scaled-up revenue. Now, of course, the pushback you get is this entire process of maximizing value puts one stakeholder in a business at the top of the heap, shareholders. And it seems unfair. After all, there are other stakeholders, and the question becomes, and it's a good one, why do we not care about the other stakeholders? Let's list out some of the other stakeholders. In addition to shareholders who supply equity to a company, there are lenders, banks, and bondholders who lend money to a company. They have a stake in the business. You have employees of the business, the very top managers all the way down to the janitors who maintain the buildings. They run the business. Without employees, the company would be a shell. You have customers who obviously buy the company's products and services. And without customers, what could a company doesn't exist? You obviously have society as a player in explicit and implicit ways. Through regulations, society determines the relationship between the company and society. Society also collects taxes. You also have competitors who might not have the same interests as you, but they are in a sense stakeholders in the game. Now, to the question of why we put shareholders up on top of the heap, the answer is not because we're playing favorites. It's because they're the only group which doesn't have a contractual relationship with the company. In other words, they don't have a contractual agreement where they can collect their share of the spoils. Lenders get interest and principal payments. Employees get wages. Customers have a contract where the product or service doesn't meet what's described, they can return the product. Society has its contract. Shareholders get a residual claim. And without giving them power, why would you want a residual claim? There'd be nothing left over. Now, of course, as you look at these stakeholder groups, there has been an attempt by some to argue that the objective for a company should not be shareholder wealth maximization, it should be stakeholder wealth maximization. Sounds pretty good, right? You want to keep everybody happy. In my experience, when you try to keep everybody happy, nobody's happy, and the same thing happens at companies. In fact, when companies try to maximize stakeholder wealth, you get what I call confused corporatism, where on any given day, the manager doesn't know which interest group he or she is trying to keep happy. And in a sense, it's great for management because you're accountable to no one, because you use another stakeholder group to explain why you couldn't deliver to one. So when shareholders say, why our stock price is down 15%, you claim you're doing good for society. When society points out the costs you're creating them, you have to take care of the lenders and the shareholders. It's great for not being accountable, but confused corporatism leads to inefficient organizations that pull in different directions. I've said only half jokingly that if you push stakeholder wealth maximization into businesses, every business is going to look like my employer, a research university. And if any of you operate in a research university, it's the most muddled institution in history. No mission, stakeholder varying from day to day, incredible waste of resources. Is that what you want your business to be? Now, of course, there will be many of you who are still convinced that shareholder maximization is too narrow an objective. And I will leave you to that thought. I believe that ultimately, if you're a for-profit business, you have to generate profits and you have to use those profits to drive value. Now, some of you might be put off by my full-throated defense of making money in a business. But even if you're an advocate for businesses doing the social good, I think you have a shared interest in making sure they're profitable. And here's why. If businesses don't make money, they can't afford to do good for society. So we're both interested in profits. I am interested in profits because I think it's a pathway to value. But you might be interested in profits because that's the only way all this good you want the company to do can be delivered. So with that long lead-in and defense of profitability, let's take a look at how to measure profits. To understand profits, first you have to understand its various definitions. So I'm going to take an income statement for a non-financial service company and look at how profits are measured and the different measures of profits. So you start with revenues. This is what you collect when you sell your goods and services. From that, you subtract the cost of goods sold, the cost of making the product or service that you deliver. That difference is called the gross profit. It's the broadest and the biggest measure of profits. From that, you subtract out other operating expenses, like what? Selling expenses, general and G&A expenses, and what you're left with after those expenses is called operating profit. This measures the profitability of the business you're in. Now, if you borrowed money, there are interest expenses associated with the borrowing. And if you have cash you've invested, you might make interest income. You bring in interest income and interest expenses. You go from operating profit to pre-tax profit. Then you pay taxes on that pre-tax profit. You have net profit. Already you can see when we talk about profitability, we have to be specific about which of these measures of profitability we're measuring. Now, if you think in terms of about those profits, there are two effects that you have to factor in that might skew the numbers. The first is the explicit role that accounting has in measuring profits. After all, earnings is an accounting number governed by accounting rules. And while accounting rules might look consistent, there are some areas where accountants are routinely inconsistent, and that's going to affect your earnings. A little later in this session, I'm going to talk about the profitability and the returns of technology firms. You're saying, what's wrong with them? Well, accountants take the biggest capex that these firms have, which is R&D, and treat it as an operating expense. I've talked about this in other posts, and I'm not going to spend too much time on it, but any accounting miscategorization is going to affect profitability. The other is the implicit role or effect of tax laws. Why? Because, much as we like to preach to companies they need to pay their taxes, there will be an incentive for companies to try to minimize taxes paid within the bounds of the law. Those tax laws are going to pay out in what gets expensed and what you report as profits. And for some businesses, profits might be understated because they found a way, the tax code is such that those companies can take a lot more in tax-deductible expenses. So with that lead in, let's look at what 2023 delivered in profits. I looked at the net profits for every publicly traded company on the face of the earth. And collectively, publicly traded companies globally delivered $5.3 trillion in net income, total net income last year. And financial service companies delivered the biggest slice of that. Almost about a third of that came from financial service companies, banks, insurance companies, investment banks. That's global. If you look at just US firms, the aggregate net income was 1.8 trillion. One out of every $3 of net income around the world was delivered by US companies. And there too, financials are the biggest segment, though technology is catching up very fast, the second largest. So that's what global profits look like on a dollar value basis. The problem with dollar profits, though, is you can't compare them across companies. A bigger company will have bigger dollar profits. So when we talk about profitability, we look for ways to scale those profits. Well, the first and perhaps most logical scalar is revenues. What are profits relative to revenues? And when you divide profits by revenues, you get profit margins. Again, you got to be careful because depending on the profit that you're scaling, you can get very different measures of margins. We talked about gross profit. If you divide gross profit by sale, you get what's called gross margin. So this is the margin after you paid for the goods and services that you've sold to other people. You subtract out the operating expenses and come to operating income. You divide that by sales, you get operating margin. If you divide net income by sales, you get net margin. And with operating margin, if you net out the tax you might have paid on operating income, you come up with the after-tax operating margin. Well, not quite a profit. If you add back depreciation and amortization, which is what happens to capital expenditures over time in an income statement, and you add back depreciation and amortization to operating income, you get what's called EBITDA, earnings before interest, taxes, depreciation, amortization. It's more of a cash flow than an earnings, but if you divide that by sales, you get an EBITDA margin. 5 different measures of margins, all doing slightly different things. So here's the first thing I'm going to do. I'm going to estimate those margins by sector. So I've broken the sectors down to the S&P sectors for both US and global companies and computed gross margin, EBITDA margin, pre-tax operating margin, and net margin. So let's pick a sector. If you take technology, for US companies in 2023, they had $2.06 trillion in revenues. Their gross margin was 47%. So for every $100 in revenues, they got to keep $47 after the cost of the goods and services they sold. The EBITDA margin is 25%. The operating margin is 19%, and the net margin is 14.4%. If you look in some sectors, the difference between the operating and the net margin is larger than in others. Those are the sectors that carry more debt. But if you can see, there's a big drop off between the gross and the net. One of the signs that a company is in a position of weakness in terms of profitability is when the CEO keeps talking about the gross margin. If you look at global companies, you get the same kind of estimation across sectors. If you look across sectors, notice that financials have no margins. You're saying why? Because I can't think of the analog for revenues for financials. Maybe you could look at loans for a bank, but you can compute net profits as a percent of loans, as a percent of deposits, but there are no revenues. That's why financials you get an NA across the board. Looking across the sectors in the US, the most profitable sector in terms of margins in 2023 was technology. It probably doesn't surprise you. The least profitable sector, okay, this might surprise you, is healthcare. Not because there aren't some healthcare companies that make a lot of money, but collectively, and we look at it a little deeper, a lot of money losing companies in healthcare. If you look across the globe, the most profitable sector is energy. In fact, energy is the second most profitable sector in terms of margins in the US and across the globe. It is the most profitable. It's the only sector globally that has double-digit margins, followed by technology, and then you see a big drop-off. Real estate, there's a big divergence between margins for real estate companies in the US and real estate companies globally. I wouldn't read too much into it. Part of it might be the way in which revenues get defined for real estate outside the US as opposed to in the US. So that's what profit margins look like by sector. I also looked at profit margins by region. The most profitable part of the world, and this will certainly surprise you, is Eastern Europe and Russia. You think, how can they be making money in the midst of the crisis they're in? It's precisely that crisis that might be allowing them to make their money. First, notice the revenues are tiny. It's by far the smallest region in the world in terms of revenues. But here's why the margins are high. First, There's a significant preponderance of natural resource oil companies in Eastern Europe and Russia. And as you saw, 2023 was a good year for oil companies. Incidentally, oil companies tend to have years in which they make high margins and years in which they make negative margins. It's a cycle of oil prices plays out in margins. So one is the dependence on oil companies. The other is the sanctions that were imposed, especially on Russian companies, has meant that the domestic market in Russia is now monopolized by Russian companies. There's no competition. Pricing power shows up as higher margins. If you look across the regions of the world, the part of the world with the lowest margins is China and Southeast Asia. And that suggests that even though these are big markets and companies want to go into them, the competition keeps margins much lower in that part of the world. Now, one way to think about margins is to think in terms of how the emphasis shifts as you go through the life cycle. Early in the life cycle, because companies tend to be losing money on a net income basis, even an operating income basis, the focus will often be on gross margin. Are you able to keep much of the revenues of what you sell because the cost is low? As you shift towards being growing companies, operating margin will move to the forefront. Early on, you don't care about taxes because you might have NOLs carried forward, you're not paying taxes. As you approach mature growth, you move to after-tax margin. And then when you become a stable company, you start borrowing money, the focus shifts to net margin. Finally, going to decline. What happens in decline? Well, you might not be reinvesting any money, no capex, but you still get depreciation and amortization from prior capex. So you might see EBITDA margins move to the front. So you'll see the focus on margins shift as you go through the life cycle. And at the bottom, I've talked about what it is that separates good from bad companies at each life cycle. So all startups might be money losing, but companies which have high gross margin have a greater chance of making it into profitability than companies with low gross margins. So as you go through each phase, not only is your focus shifting, but you're also looking to see how benefits play out as changing margins. So to see if there's any basis to the life cycle, here's what I did. I computed the margin by decile, by breaking companies down by age into decile. The way I get age is I look at the founding year, I look at 2024, and I look at the difference. And I break them down into youngest firms in the bottom decile to oldest firms in the top decile. Now, if you look at gross margin, the oldest firms have higher gross margin than the youngest firms, but the differences are not, they're all over the place. In the middle, you can see they jump around. Now, EBITDA margin, again, all over the place. In fact, the highest EBITDA margins are in the middle-aged companies. But if you look at operating and net margin, you can see the youngest companies struggle, especially on net margin. They have trouble making money. So when you look at a young company losing money before you give up, remember, this may be a feature rather than a bug of where they are in the life cycle. So that's one scale art to revenues. There's another way you can scale profits, which is to how much capital you've invested in projects. Here again, there are two variants, and I'm going to use a financial balance sheet to illustrate the two variants. One is an equity return. What do you look at in an equity return? You look at the income that goes to equity investors, net income, and you scale it to what the accountant said is being invested in equity, book value of equity. That's called return on equity. The alternative is you look at operating income, which is to both capital providers, debt and equity. You look at it after taxes, but instead of dividing just by equity, you look at book value of debt plus book value equity. But you net out cash because cash is not invested in operating assets. The operating income doesn't come from it. That's called invested capital, and that return is a return on invested capital. Each measures returns, but to different claim holders. Now, we'll talk later about how these different returns play out. But again, let's look at these returns across sectors to get a sense of the most profitable sectors in terms of returns and the least profitable sectors. Let's take the US. In the US, the lowest return sector is real estate, 4.05% return on capital, 4.37% return on equity. Now, I'll leave it to the real estate people to tell you whether this is a problem or not, but clearly in an income basis, real estate is not delivering a great amount of return on the capital invested. Maybe reflecting how the price of real estate has gone up in the last decade or so. Second lowest is utilities, 6.08%, but there it might reflect the fact that you are in fact in a very safe business. And remember, many of these are regulated utilities, but they're not allowed to earn more than their return equity. Than their cost of equity. So there's actually their pricing power is restricted as they earn higher returns. Look across the remaining sectors in the US, at least. Technology companies have the highest return on equity and return on capital, and energy is pretty close. Okay? In fact, on return equity, energy might be slightly higher. With technology, though, the caveat is what we mentioned earlier. Remember that accountants don't capitalize the biggest capex at a technology firm, R&D. You're saying, why does it affect return on equity and capital? If you expense your biggest capex, it won't show up in your balance sheet as part of your assets. Technology companies understate capital invested because of the way the accounting is done. I still think technology firms probably earn a healthy return equity and capital, but I think the numbers you see there are overstated. As for energy, it's a different reason. Oil prices are high, returns on energy companies will be high. Oil prices drop off in 2020. Energy was the worst performing sector in terms of accounting returns when oil prices hit $35 to $40 a barrel. Global companies, energy moves to the top, technology is now second. It was a very good year for energy companies, and I want to reinforce that. And real estate and utilities again bring up the rear. So there's something to be made. With banks, insurance companies, investment banks, financial service companies, you can compute a return on equity. But there's no such thing as a return on invested capital. And here's a simple reason. Debt to a non-financial service company is a source of capital. Debt to a bank is raw material. You borrow money at 4, you lend it out at 5. So with banks, everything stays equity focused. Now, if you break these, if you stop with those returns, say, are those good enough returns? You probably can't get to an answer. So I'm going to close the sale here by computing what are called excess returns. This requires bringing together what we talked about in the last session about hurdle rates, cost of equity and capital, and this session about return equity and return invested capital. Now, the way we compute excess returns is we compare the return equity to the cost of equity. That gives you an excess return on equity. You want your return equity to exceed your cost of equity. Alternatively, you can compare return on invested capital to cost of capital. You want your company to earn a return capital greater than the cost of capital. So which one should I use? No reason why you should use one or the other. You can do both. In fact, that's exactly what I did by sector. I computed the return invested capital. I computed both the equity excess return and the capital excess return. But before I go to this table, I want to lead in with something that I think is going to change the way you think about excess returns. With every sector, here's what I did. I first look at the percentage of companies that are money making. So if you look at energy, 40 in US, you look across US companies, there 45.8% of US companies had returns on equity greater than 0. So 53% or 54% were money losing. I took only the money making companies, and among the money making companies, 83% earned more than the cost of equity. That's one of the highest numbers. If you look across, 83% of energy companies which made money made more than the cost of equity. But don't forget, 54% of energy companies lose money. And I did that for every sector. So for every sector, keep your eyes on two numbers. One is the percentage that have positive returns on equity. You want that number to be higher if the business is profitable. Utilities, for instance, have the highest percentage of companies with return equity greater than cost of equity. They're also have the highest percentage of companies that earn more than cost of equity, but what they earn above the cost of equity is tiny. It's nice being a regulated monopoly, but you can see the variations across the world. Now we'll come back and talk a little bit more about the difference between US and global companies on the next page, but you can already see across sectors, in every sector, a big chunk, and it depends on the sector, of companies are money losing. And among money making companies, there are a lot of companies that earn less than the hurdle rate on both an equity basis and a capital basis. Now I looked at these excess returns by region, and I'll give you a minute to take a look. But again, you're looking at two statistics: the percentage of companies in each region that earn more than 0, that are money making companies. As I said, you want that number to be a high positive number. And the percentage of those money-making companies that earn more than the cost of equity. Let's take the US. The US, 37% of companies had positive returns, which means 63% of US companies are money losing. But among the 37% that were money making, 72.6% earned more than the cost of equity. So among money making companies, it's common for companies to beat their cost of equity in the US. If you look globally, the statistic on companies making money is higher. So globally, more companies on a percentage basis make money, but globally it's 50-50 in terms of what percentage beat the cost of equity and what are less. And it's very similar for return on capital and cost of capital. About 54% make money on an operating income basis. It's about 50-50. Earn more than the cost of capital and 50% earned less than the cost of capital. So if I were to sum up on excess returns, it's not a pretty picture. Because remember, even though among money-making companies, there might be a high percentage that beat the cost of equity and cost of capital, at least in countries like the US, those money-losing companies are earning less than the cost of equity and capital. I just didn't count them because I didn't want to skew the statistic. But if you bring them into the picture and you look across the world, here's the depressing truth. There isn't a single part of the world where a high percentage, in fact, there's not a single part where 50% or more of companies earn more than the cost of equity. Canada is and Australia are kind of a puzzle. There are people who've looked at the numbers tell me there are a lot of junior mining companies that lose money. But if you look across the companies in the aggregate, there are lots of money-losing companies, and it's very few companies actually earn more than their hurdle rate. So what I take away from this, and you can do this by sector as well, is making money is tough enough. Beating a hurdle rate is even more difficult. And that leads me to my conclusion and back to my end game. Start of this session, I said the end game in business is to make money. And then increasingly over the last 2 decades, people have pushed back saying that's too narrow an end game. But the critics of the traditional corporate finance end game seem to be operating under the presumption that shareholders are getting a very big slice of the pie, that a big slice of the overall pie is going as profits, and that shareholders are earning more than they deserve. But as you saw from those excess returns, shareholders, for the most part, are struggling to make their required return back. So in other words, the starting point for all these broader missions, stakeholder wealth maximization advocates might be a false premise, which is there's a big pie, shareholders are getting a big slice, we want some of that slice. It might be true that if you take the biggest winners in the market, the magical 7 from last year, the FANG-AM stocks over the last decade, the biggest companies, anecdotally, in those companies, you could argue that shareholders get a big slice of the pie. But those are the exception. Across all companies, you can see it's become more difficult rather than less to make money, more difficult rather than less to earn the hurdle rate. And I would attribute part of this is to globalization. 40 years ago, you probably had a domestic market where you're protected from competition. Very few companies have that. And the other is in the last decade, we encourage disruptors. I have always had mixed feelings about pushing disruption for the sake of disruption, but we threw capital at companies that promised to break the status quo. That was in fact your preaching point, right? We will break the status quo. And nobody seemed to ask the question, what would you replace it with? By making billions, hundreds of billions of dollars of risk capital available to these disruptors. We've broken businesses that used to be solid money-making business where you could earn more than the cost of capital. We're scrabbling for scraps off the table as stakeholders and acting as if shareholders are getting this gigantic slice of the pie and saying, I want that, strikes me as delusional. So on that depressing note, I want to end the session, and I thank you very much for listening, and I hope you enjoyed this session. Take care.